All right, we're up and running. Right, special situations. The reason for doing this is you won't see these very often, but you want to know what to do if you do see them. So let's go and have a little look at a few of these. Most of these came around about COVID time. A lot of them, some of them I've seen since, but a fair few of them are very sort of specific to extremely exaggerated crises. So we're going to have a little look at a few of these. I saw a couple of comments coming in. We'll perhaps cover some of those tomorrow after CPI, any sort of trades, replay type stuff to go and have a look at. But you keep them coming in, trade ideas, stuff that you've seen. We can always go and have a look at them after CPI tomorrow. Right. All of these are mostly relating to global crises. Now, a global crisis, similar, sort of progression to most others, it's just a spread, ultimately. Most of these start, if you take COVID, for example, it starts with some kind of initial story, which in itself possibly isn't that big a deal. I'm more than happy to admit that when COVID started to appear in China, I thought, this sounds like bird flu, probably not a problem for me, and left it there. Which incidentally was what the ECB said as well in January 2020, which seems a little bit short-sighted of them. It's easy for me to say. But what you end up with and what you have to do in a situation like this is look at that and go, okay, there is something going on. Is this a massive deal or not? Or what at least you want to start looking at? So like we did before, go and have a look at what's getting affected. The first things that get affected in this situation in COVID was copper and Chinese yuan. Copper had a pretty hefty drop in January 2020 and then started to bounce back once China brought in lockdowns in Wuhan. I'm not going to go through the whole progress. I've done a series on this somewhere. That was about 8 hours of the whole progress of COVID and what happened throughout it. But with any of these things, you get an initial story. This ultimately doesn't do a great deal of anything until it starts to spread. Same in 2008, you've got this initial story of a couple of sort of housing related or mortgage related hedge funds started to stop redemptions, and that in itself you think, well, there's a couple of funds have not done too well, not a problem. When that starts to become consistent across multiple funds, then starts to turn into banks, that's where the problem comes. Similar with countries in 2011 and the European debt crisis, it was the same kind of thing. To start with, what you get during these contagion phases is a general increasing of volatility, a general risk-off type of action. Commodities are going to be influenced by whatever it is that's going on. From what I've seen of, well, at least 2008 and 2020, you would assume that commodities will weaken. If the global economy is all over in trouble, growth's going to go down, spending's going to go down, demand for commodities goes down. So commodities will generally get hit in these types of situations. This is where you would expect to see buying of gold, movements to safety, gold, bonds, dollar to a lesser degree. The difficulty with currencies in a global crisis is, why is one better than another? If everyone's affected, well, having dollars is no better than having euros, to a point. After a while, it does become a better choice. So, the next bit you get to, and this is where it morphs from whatever the initial problem was into something completely new, which is the fear and panic stage. This then has less to do with, and take COVID for example, this had almost nothing to do with COVID. By the time you got to mid-March, the number of people who've got COVID didn't really matter in the sense from a market perspective. This was much more about credit availability. Banks fearing that other banks couldn't pay, essentially, so everyone stops lending money. As soon as money stops flowing, the whole financial system sort of grinds to a halt. Then you end up with a situation where anyone who's got some money can charge crazy amounts to borrow money from them. This creates a huge problem, perpetuates margin calls, markets start to move based on that. You end up with worlds of problems. This requires a reaction, a bit like the Bank of England one that we looked at before. Without a reaction, it doesn't get itself solved. People aren't suddenly going to go, actually, it's probably all right now, and the solution comes. Unless, of course, there was a vaccine very, very quickly, which obviously didn't come, and those types of things are not something that you can react to and create it. By all accounts, that vaccine was created in astoundingly fast time. Be it whatever your views are on vaccines. I'd like to know Joey's. Yeah. We know he is. And then generally, once you've got the reaction, the problem's to a degree solved, you've then got the economic knock-on, which at the time you don't know what it is. I'd love to have said, oh yeah, I could see this coming in 2020. I didn't see inflation like that coming. You thought inflation seemed logical, afterwards, and as everyone got past the vaccine, it seems sensible that people come out and spend money. You know, I'm sure we all felt it ourselves that you probably had a fair bit of money that you managed to save just by virtue of not spending. You could go out and spend the money. So that makes sense that inflation is going to go up a bit. The degree to which was more to do with supply chains. But you don't know precisely what that's going to be at the time, but it's something that is probably then going to lead to further knock-on consequences over time. Right. What we're going to go and have a look at then is some of the early things that will happen in a crisis. So I'll kind of, rather than sort of have slides, when it gets the action of it, the big sort of moment, if you will, the sort of big kickoff of COVID was when Italy locked down, or they locked down part of northern Italy. That was the beginning of it, because that kind of set the benchmark for what's going to come next. Prior to that, they'd done the lockdown in Wuhan, which should really have been your benchmark. Yeah, if you saw that, you should have thought, well, it's probably coming, but no one did. COVID has started spreading around, etc. I think by that point, by the time Italy locked down, there was like 5 cases in the UK. So it still wasn't seen as a huge thing, but it's the lockdown that's the bigger thing. I also did not realise the impact of closing schools. When they started closing schools in Italy and places like that, markets started dropping so fast because suddenly you were taking parents out of the workplace, so productivity just crumbled. Did not think about that as an implication, but that was massive. That happened, the lockdown happened, and when you got that lockdown, that was then the beginning of the move, and you got what you call a Sunday night gap. It happened over the weekend, so it's Sunday night. You obviously got a greater chance of a gap on a Sunday because you've got Friday, Saturday and Sunday's worth of news to get a gap. Otherwise, in most markets nowadays, you've got a 1 hour window for news to create any kind of meaningful gap. So, we have this situation. You get on the Sunday, it was the 24th of Feb, you get a gap. I've not got the recording of that, but I can show you another one to try and illustrate what happens and how you go about trading it. This is an example. If you want to go and have a go at this one, this was, I should have had all these put up on here, the 15th of the 9th, 19, and it's 11 o'clock at night, UK time. This Sunday night gap, this was over the weekend an attack on Saudi oil facilities, all of their refineries. Loads of them got bombed or attacked in some way, taking out about 30% of their production capacity, which for Saudi Arabia is enormous, bearing in mind that they're top 3 in the world. So this then is an instant restriction of oil supply. You get a big gap up. So what I've got here is that's a 15-minute chart, I think. No, it's a 5-minute. That's a 5-minute, that's a daily chart. When you get these kind of gaps, what you've got to work out, or what you're playing for to start with, is straightforward stops to get triggered. This is a daily. So anybody who got short in the previous, that was from mid-May, between mid-May and mid-September, anyone who got short in that period and is still in must be offside, because they can't have got short anywhere below here or anywhere above there. So you've got an absolute mountain of people who are offside on this. What you're playing for then is on the open, you're playing for stops. So a bit like the gilt one that I talked about. So I'll show you an example of this. You're playing to buy this on the open for a stop straight up, and it's going to just jump, ping up as everyone starts getting stopped out. Oh, also a load of people are going to try and get in on it as well. So in spite of the fact that this closed down at 55 and opens at 61.5, so $6.50, you still get this jump of around about 200 ticks on the open. The difficult bit of this, or the bit that you've got to kind of have planned out, is this is going to be super fast, very little liquidity. It's going to be very hard to gauge, 1, where the price is off the ladder, and 2, where you should get out. I don't think there's really much you can do in terms of targets. You have to just, and the way I've approached these, you get in, you watch it flash up the page. Once it seems to gain a little bit of liquidity, that's probably a fair place to get out, because that's the point where people have got at least some willingness to execute, and you would assume on a jump that far, there's probably going to be a fair few people trying to sell on the back of positions. If anyone's long already, or anyone bought it on the open, you're going to get a fair bit of selling in it. The other thing to consider with these types of trades as well is how far you're willing to go to get in. What will happen, I'll show you in a minute. On the open, you will see a little box that moves, and the box shows you where the opening price is going to be. The way it works is it aggregates everybody who wants to buy and everyone who wants to sell. So they find a price that matches the greatest number of buyers and sellers, essentially. So this little box will move. You've got to watch the price is going to open and work out how far are you willing to go on this. If this had opened at $80, even with that news, it would be quite a difficult one to justify buying that, you know, for a 50% or more, 60% jump. That's a hard one to justify buying. This is why I say get a daily out. You're looking at that thinking, well, you've taken out these couple of highs, so you'd be quite happy to buy it there. This is almost an ugly no man's land here. That if you're buying above 59, you don't want to buy too close to 61 in case there's people willing to sell it at 61. So you almost, if it's going to be up here, you'd prefer it either opens at 59 and you can go to 61, or opens above 61 and then you can play it up. So you got, you know, just get a daily chart out or an hourly, dependent upon what's the most relevant. Just work out where you want to be in and where you don't want to be in. Like I say, once the move happens, the goal is get in, get out, job done, go back to bed until the next morning, generally. Liquidity is generally pretty light on the back of these types of things. It will whiz around for the rest of the evening. Quite hard to actually work out what's going on. If anyone does replay this, go and have a look at the period just after 1:30 in the morning. Absolutely gigantic volume, and it trades in basically 120 tick range. If you want to have a go at scalping, I would suggest just looking at the volume. I've not done this. I keep meaning to go back and do it. Looking at the volume over 100 tick range, that could be amazing scalping opportunities because it will just move and move and move and move and move, and there'll be flow in it. So probably worth a look at that one. But that's the whole idea. You know it's going to gap up. You can watch the little box and then you work out where you're going to go with it. Like I say, on the exit, you've got a few different options. Wait for some liquidity to come in and get out. You could wait for a large order to chase it up, and if that starts to get hit, just hit the large order to get out. Chances are it's going to be so fast that'll be hard to do. The other is you just pick a number of ticks and go, well, if it gives me 100, I'll take 100 because I've got no idea how far it could go. And there's no way of calculating, working out, planning out what it's going to do. It's going to go, you don't know how far. That's what you try and do on it. I'll bring this up on, I was going to call it iPlayer, then it's not iPlayer. It's Media Player. Right. Oops. Just trying to do it off the board on PowerPoint is an absolute nightmare. Right. Okay, so I'll get the red pen out. What you'll get on the open is this type of thing. So you'll get a price where it will show bids below price, offers above price, and then it will show a bid and an offer at the same price. Now the idea here is that, well, if people add here, let's say 60-10, if you put an order here, then the price is going to have to move up, so that let's say you put 10, that needs to find 10 sellers. So the price is 11 there. So let's say it's 20. There's 11, 4, 1. So the average price is going to have to move up so that it aggregates and finds enough buyers to match sellers. In terms of execution then, the way that you get in on an open like this is you put your bid above the box. Now you can place a bid, no one else can see it. I don't know why I can't draw anymore. Let's see if that'll do it. There we go. You place your bid above the box. So if you place a bid here, it will show on your system, it won't show on anybody else's. So you can't see what's there. As long as the market opens below you, you'll get filled on the box on the opening price. So you can put this 300 ticks higher. Just beware that if this jumps in the last seconds and opens 299 ticks higher, you're filled. And that may not be a point that you really want to get in at. So have a think about it and think, right, where's the max I'm willing to go on this? Put your bid there. If it opens below you, wonderful. If it opens above you, well, you probably didn't want it anyway at those prices. That's the way that you go about doing it. So you're watching the box, like I said, you've got a level at 61. I'd be watching this thing get over 61. People can game the box as well. If you put a really large bid up here, that will pull the box up in order to match it against enough people. People can do that, pull the box up and then pull it just before the open, and the box will flash back down and then they can buy it. So there is a little bit of people can game the box a little bit. Don't worry about people doing that. I would say you just got to pick what you're happy to go with. Once orders stop flashing around and the exchange decides that it's liquid enough, it's settled enough, they will then allow it to open. So they've already let the S&P open. So the S&P's open. I wouldn't expect too much movement in the S&P, but you've got S&P, I've got oil there, gasoline there as well. Gasoline's going to be another one. Gasoline's absolutely wild market though, so that's a pretty tough one to trade. Bear in mind, that's tick compressed 6 times on gasoline there already. So the box will keep on going up. This way you've got to keep your eyes on the box and work out, are you willing to still go in on this one? and it will just keep on moving until, I think that you can go and see on the website, I think they might explain like the level of liquidity they want to see around the box as well before they're willing to open it. It's not just a case of, has it seemed to stop moving? So at 61 now, you'll be looking at that thinking, right, I'm quite happy to go for this, because if it opens and anybody ticks it up, great, you're going to hit a ton of stops and you're going to fly. So you now be pretty confident, get your bids in. Like I say, if you haven't just put a bid miles up, the other choice is you place your bid and you keep dragging it up. Danger of doing that is it skips above you and locks, and when it locks, that's the point when the exchange is going to open it. You don't know precisely what time that's going to be. So if you keep moving your order around, if your order's not in when it locks, you miss it. So there we go, that was the open. What you've got there is it opened at 40 and then instant, done that again. There you go, instant volatility stop. So the CME has rules around, you can Google it, if you put CME volatility logic, it explains the criteria that goes into placing or for the market to shut. Volatility stop, you get the same game again, bid and offer at the same price, and this will then move until it reopens, till they feel that liquidity is settled once again enough. So if you put your bid in above the box, you would have got filled at the open price. It traded 40 and then jumped. So it's taken 15 ticks without any trade at all. So you're long at 48 now if you got in on that box. And then you're just waiting for this to reopen. That's what you end up getting from a sort of price adder. This is why I said it's really, really difficult to get any sense as to where you want to get out. But when you get that volatility stop again, there, at this point, it's now up, what's that, 130 ticks from where you got in, 140 from where you got in. What you can do, I learned this the hard way, if you place your offer, so you want to get at sell to get out, place your offer at a scratch. As long as it opens above you, you're out. When the volatility stop reopens, just gives you that little bit of protection. So you could do it like that. You don't know precisely where this is going to open, but it's probably not going to open right back at a scratch anyway. It just means you're straight out. Again, it's another one of these ways to approach it and go, well, I have no real other reference to go with. Put your order in for a scratch and see what you get. There you go, so it sits at 90. It seems to stabilize, and there you go, so you would have been out at 87 there. Otherwise, it flashes down, it's down to 40, then up, back down, it's all over the place. You can trade that. It's a dangerous game. You can place a bid and an offer and they'll just disappear off the screen. It will just keep hitting you. You can do that for a while. You've just got to be very, very clear. Go and have a go at it and replay. Very clear that when it seems that you take a loss, don't then keep playing the game. So it might be that you can get filled long and out, and then you can't get out. That's the indication to stop it. One of those, how much value is in it, I'm not sure. If you get lucky, you get 3 or 4 of them right and you get 50, 60 ticks each. You get one of them wrong and you lose 100. It settles down reasonably quickly. This is the other point where you could say, well, just get out. It seems to sort of have got that level of sort of liquidity back into it. It's trading with a degree of normality. Once you've got that, then you could sort of go, okay, that's fine, I can get out of it. There we go. That's about as long as you'd want to be trading it. I wouldn't be sitting in there for longer than that. Yeah, even that for me, I think is too long. I would have probably given it up on the volatility stop just to be out of it. Yeah, it was a fortunate one with volatility stop. It's gone far enough that you go, well, it's 100 ticks, probably take that and be done with it. So there you go, there's your Sunday night gap. It very quickly is already back at a scratch as well, which is the other reason to not do these trades. You know, a lot of these people buying, and then, or the people selling, a lot of them are going to be people like us who bought it on the open, it's whizzed up and they've gone to quick sell it, and then they're chasing each other to get out. You don't get them that frequently. We've seen a few. The Donald Trump election, you saw it, there was one on there. Bitcoin on Monday, I think it was, gapped up quite significantly as well. There's no real news. That's a harder one to trade. You know, why it's gapped up and how far is harder to justify or harder to actually take on if you don't have any news behind it. Oh, move on for that one. This is then what you got on the back of the Italy lockdown one. Exactly what you'd expect, really. Gold gaps up and continues. Gold did 300 ticks on the open there and then continues onwards. One thing that I have noticed a lot with these types of gap moves, particularly when you gap into very open space, is you get a lot of very sort of reactive trade. The nice thing about this type of thing is there's only so many levels that you can find, and you're looking at the same levels. You know, something like that, this is a 5-minute chart. Everyone sees the same level. So it means the market reacts a lot better from levels. Doesn't mean it holds them every time, but you know. You get filled on the level, it either puts you straight on side or straight offside, decision made, move on. And you can keep on trading like that. It's almost a case of you do the simplistic things and they work. It's the simple stuff that works, because basically everyone's trading the same. You know, stuff like that, it hits the level, hits the level, hits the level, breaks, sweeps the old range. It does a lot of really sort of simplistic stuff, makes trading nice. It's just sometimes quite hard in the sense that you're like, surely it's not this easy, but this simple. You're like, oh, it was support, now it's resistance. And it generally works. The good thing about volatility as well, which is another thing to make sure you think about, when volatility goes up, yes, you will be proved right or wrong much, much quicker. So you got to deal with the fact that you're going to put on a trade and you get stopped out within 10 seconds of entering the trade. That's annoying. The thing that you most need to remember though is don't snatch profits. If you've got a target, play it to the target. You know, something like this, you buy it there and you're, oh yeah, we'll play it back up the range. That's 90 ticks. It's a real easy one when people go, oh God, I'm on side 20 ticks in 10 seconds, take it. You don't want to do that because you'll go offside 20, 30 ticks in 10 seconds as well. This is where relying on a chart to define where you're going is really important. Get your chart and go, right, if I'm buying it here, where's my next point that I'm going to? And you go there, and if that happens to be 200 ticks away, well, that's the target. If there's nothing else there, go for it. The mistake people make is they snatch profits, and you'll get burnt for those profits so fast when volatility is high that you'll never actually make any money, and you just go around in this cycle of big loss, big win, well, bigger loss, bigger win than normal. You know, if you've got the chance, if you play this break, for example, if you get that wrong and you're buying it, you're probably taking a loss here. Yes, it will hurt. It's going to be 30 ticks or so. Not great. But if you play the break, if you're doing it that way, that's 70, and then it does another 100 in 2 minutes. It's really, really quick. It's really, really clean. That's the kind of stuff you've got to remember, that yes, they go wrong and it slaps you in the face for 30, but when it goes right, it gives you 100 if you stay in for it. If you get too snatchy with your winners, you end up not taking enough out of it, and you kill yourself in those situations doing that. But you've got these gaps across the board. The S&P gapped and then continued. What you also started to see, and maybe it was more once it started to come into Europe because Asia had seen and put a lot of their moves in. Once you get the Europeans come in, and you saw this on the US election as well, as soon as the Europeans come in, then the move gets accelerated. That was the beginning of the European session in the S&P. Far bigger move than the gap itself, but you got this whole situation of just gaps. If the gap takes you out of a big range as well, then you've got a lot of scope for movement. This was then the beginning of that just all-round risk-off type scenario. So the next bit from your sort of risk-off initial problem, escalation of it, is the contagion part. There's a few things that are worth watching to give you a bit of gauge on this, and a gauge on what the next thing is that's going to happen. So this is where you're then moving from the sort of contagion and this escalating out. This was the point essentially where the impact of COVID on a human level didn't have so much market influence, and it was much more about the way markets were trading. Few things to look at. VIX is always a good thing to look at here. I'm not somebody who's going to sit there watching the VIX every day. I'm going to assume the VIX is probably somewhere around about 12, 13 at the moment. I couldn't tell you. I don't need to know. It's not moving dramatically. You know when volatility is picking up anyway. So once you see that volatility is picking up, that's then the point to go, okay, well, I want to have a look at the VIX and see where we are. If you've broken, say, a significant level on VIX, that perpetuates volatility. The reason being, a lot of VAR models use VIX. So VAR is value at risk. So the amount of risk that you've got in your fund, in your portfolio and whatever is measured, and VIX has an impact on that. If VAR goes up, the general rule is, well, you should reduce risk. So this then means that larger funds, etc., start to reduce the risk exposure that they've got. If that means selling, that often ticks the VIX up even more, which perpetuates the problem again. So seeing the VIX get over a significant level can be helpful in, if nothing else, your sort of willingness to expect a lot more. You know, oh, it's 3% down on the day, surely it's going to bounce idea doesn't work. You have to look at it and go, that's quite reasonable. It could go further and further and further. The next two are more about credit, this is the phase of full-on panic. There's a couple you can look at. This has actually slightly been replaced now. You could look at this as a SOFR Fed Fund Futures spread rather than an FRA OIS. FRA OIS are both OTC, so they're harder to actually get prices on, harder to find the information on. But the whole idea of it is, one is a forward rate agreement, the other is an overnight index swap. An overnight index swap is just swapping payments. Forward rate agreement also has a capital aspect of it too. With that in mind, one of them effectively has a credit risk to it, that you are lending the money, or at least agreeing to lend the money, whereas the overnight index swap just exchanges the payment. So you keep your money, but you're, rather than paying a fixed rate, you're paying a floating rate of interest. So there's no credit risk in an OIS. There is a credit risk in a forward rate agreement, similar to Fed Fund Futures versus SOFR. So what this means then is this is a great way of assessing whether banks are willing to lend money to each other. They may be willing to engage in swaps, which are then tied to short-term rates. They may not be willing to engage in a transaction which could imply somebody not paying you if they need to at the conclusion of that agreement.
And so this is what you meant before when you said about it was less to do with COVID and the human impact.
Yeah, it becomes a credit problem.
Right.
Because banks don't lend to each other, then they're not going to lend to anybody else. Companies can't, roll over their borrowing. It's a huge amount of borrowing and lending that happens on a very short-term time frame basis. And so if that stopped happening, you end up very quickly, particularly in America, they've got really big money markets, commercial paper markets. Commercial paper is predominantly a way of firms paying wages. So they issue 30-day debt. They get in a lump sum, pay wages, pay off the debt throughout the month, issue 30-day debt, pay the wages, etc. They do it for other sort of commitments they have as well, bills, all of that type of stuff. But there's a lot of revolving credit like that. If suddenly banks won't lend money, that all dries up, then you end up with firms who can't pay staff, can't pay bills, can't pay lots of things, and that's where the problems really start to set in. So that gives you a sense of willingness to lend. The solution to that is rate cuts. The other thing, which is then the next step of the full-on panic, is the cross-currency basis swaps. So this is the difference between, I'll explain in the next slide. Right. All right. So I'm just looking at the order of my slides so I can explain it. What a cross-currency basis swap is rather than just a straight FX swap, where I give you some dollars, you give me some pounds, and we agree that we will exchange those back in 3 months' time at a set rate. The addition part on a cross-currency basis swap is I give you dollars, you give me pounds, you pay me dollar LIBOR, I pay you sterling LIBOR. So that what that does is that should theoretically mitigate the exchange rate risk, because if the exchange rate becomes more favourable to one rate, should go higher in that, so you're paying a higher rate. What happens though is when you get a proper panic, people want dollars. Dollars is the safe place to go. So what you end up with is a situation where anyone who's got dollars can ask for dollar LIBOR, or SOFR as it be now, plus 50 basis points, 100 basis points, 200 basis points. So therefore that then accelerates the demand for dollars, because if you don't get hold of them quickly, if you have any dollar denominated debt, you're going to pay a lot more money for your dollars because everybody wants them. Incidentally, I believe now there is $18 trillion worth of dollar denominated debt out there. So people need dollars very, very quickly in a panic. It's not so impactful in, say, the UK or Europe, but if you are Turkey or Bolivia or somewhere like that, it's easier to issue dollar denominated debt because people know what they're going to get back. They're going to get dollars. What people don't want is to lend Turkish lira. They get their Turkish lira back and find it's devalued by half. So they're getting paid back far less money. So a lot of emerging economies issue dollar denominated debt. But if everyone runs for the dollar, their debt repayments spiral because they've now got to convert their lira into dollars to pay their debt. And the lira is depreciating because no one wants emerging market currencies in a panic. Lot to that, but basically, if you start seeing that going up, that's bad news. Solution to that is swaps, swap lines, central bank swap lines, or QE. So we'll get on to all of that in a minute. Right, VIX. This will be the first thing. As soon as you start seeing VIX jump up, expect bigger moves. The thing that you always should remember is once you get a bigger move, this increases the chances of increasingly large moves, rather than this be seen as an anomaly. If there's a reason for a significant move, then what you end up with is the significant move creates more significant moves. From a indicator perspective, rising ranges will increase ATR, and the higher ATR increases expectation of higher ranges, which creates a higher range, which increases ATR. So it increases much, much quicker. What I do, get a VIX chart up, and you just want to go through previous highs. Where are they? Once you start getting through some of them, that's where you're going to get a further acceleration of selling generally. Just to give a little illustration of a few points, we actually saw this in August. The VIX went to 60, which is the highest it's been outside of a crisis for about 2 days. Post payrolls, there was payrolls at the beginning of August. There was a big miss, and then everything went nuts on the Monday, and it all died down by Wednesday, and that was that. It was, yeah, really odd. It was very, very similar to that one, which was February 2018. Same thing, you got payrolls, markets went really volatile, really thin, and then it went bananas on Monday, and it all died off. That one took a bit longer. That was about 2 weeks of volatility. But after that, you then seen VIX dropping and dropping and dropping. Like peaks in VIX was that 35 was December 2018 surprise rate hike, or not surprise, but undesirable rate hike. August 2019, I can't, some of the trade wars, but then after that, you were really getting quite low levels of VIX. Nothing compared to over here, where you were getting pre-Feb 2018, you were down in like the sub 10 VIX. That's not where you want to be. But once you get over about 25, my view is these are getting ideal trading scenarios. Get over 50 and it starts to get a little bit wild. That's where it starts getting quite tricky, once you're over 50. Right. The good thing with the VIX going up is it improves markets on close. So we looked at these last week before, on the month end. Closes get far better when the VIX goes up, partly because if VIX is increasing, so implied volatility is rising, people don't want to hold positions overnight because you don't know what might happen overnight. So you have this, what you start to get is far more volume getting done at the end of the day compared to the beginning. You have this greater propensity of people to exit positions before the overnight. You also have a situation where margins will start increasing. CME will do it and they'll increase margins. If that happens, then again, it's more expensive to hold overnight. People are more inclined to exit positions quicker and quicker and quicker. So another reason then that the closes get better. Something that you definitely want to do, and it's hard because it means long days, stay for the closes, stay for all the closes when volatility starts picking up. These are some of the best moves of the entirety of all of that COVID period, because you knew it was coming every day. A lot of the other big moves were predominantly around news, which it wasn't necessarily coming today or tomorrow. And in between, you just had immense volatility. Come the closes, you know that the close is coming. You know people are going to have to exit or at least flatten positions out. You should get some movement. And if you get movement, there's going to be a lot of it. It's definitely a period where you should just stay, work for your 14, 15-hour days, because it'll be worth it in the long run. I remember this, 2011 was similar. August 2011 was crazy volatile for a while. And if you stayed for all the closes, you can have an amazing month just on the closes. Obviously, you add that to what was already a very good month, so that was the kind of time to push it. The temptation is, well, you could have got to 4 o'clock in the UK and go, do you know what, I'm on a very, very good day. I'm 3 times bigger than a normal good day. I'll take that and go home. Not the time. Push it and push it and push it. You could turn that into 10 times an average day on the closes. Because remember, you're not just trading the S&P close. You got the European closes, you got the oil close. Oil closes were crazy at the time because of how much oil was moving. Yeah, that was one in February, I think it was, and that does $3 on the close. Sorry, that wouldn't be, that was a March one. It does 300 ticks on the close in like the last, that's a minute chart, last 10 minutes, there's 300 tick close. So they're worth being there for, and you trade all of them. They're not all gonna be great and you won't make money on all of them, but if you catch one like that and it goes and you manage to get on it, you can increase the size as the move goes. That's where you can double your day on the closes. So worth being there for. Right. We're going to have a little look at an example. If you want to go and have a go at one, this was the end of Feb was quite good because that was the beginning of COVID. 27th of Feb, go and have a go at. This is actually an up one as well. And usually most of the good closes generally go down. It's not to say they have to go down, but from experience, I always feel the better ones, the ones that progress more, are the ones that go down, not up. This one went up, you got a sort of drift, and then you got stops. Incidentally, that is before the stops move here, that had done 50 handles in 15 minutes. So it's well worth being there for. The volumes are also huge. So it's 150,000 contracts on the close. So well worth trading those. So go and have a go at that. It's worth it if you want to practice closes. Obviously, these will be the most extreme ones you'll see. Anytime, or basically just do every end of day throughout March 2020. Bear in mind the time change, because that was when the clocks shifted. So just bear in mind that there will be a week in that where you'll have to do it from 7:45 till 8 rather than 8:45 till 9. So just bear that in mind if you do go and replay them. Right, we'll go and have a little look at this one. This was the 12th of March, so you'd already had a huge Fed-related repo injection, which had then reversed like all stimulus does. That reverses, then you get the close. Don't dismiss the technicals. If you break a technical point on a close, this can then just perpetuate a move, made bigger and bigger and bigger. This is where we'd sat all day down at the lows down here, 24.87. Once that breaks, then you've got the potential for a further acceleration lower. That's the bit that you're interested in, and you're going to try and play for that bit. Go and have a go at it. It starts off with 5 minutes to go. You're up here at 25.26. That does 90 handles on the close in 5 minutes. This is well worth trading. I'll give you an example. Where is it? So the one to watch is the S&P. That I've put the chart over the video so you can see it. What you're watching, S&P there, starting off at 26. With the closes, one of the things I'm always doing, get a clock, get a big clock on your screen, and make sure that you try and carry some of your position all the way to the close. Once you're starting to get towards 5 minutes to go, if you start to get any sort of clear direction, which is what you've got here from sort of 26 down, also it happens to get yourself back, or it's just coming back down the range here. Once you get some direction, this is then the point where you can commit to it reasonably early, except that it may not go. If it doesn't go from 5-2, then my general approach is to step back and wait until 2 minutes to. But if it shows direction at 5-2, which by this point you're now getting back below 15, that's the point where you go, okay, I can go for this one now. So got in around 25, broken 15. One of the things that you're also looking to try and do is sell on pullbacks. Don't chase it down on closes, particularly the volatile ones. It will rotate in ranges. So it keeps dropping down to sort of 06, 07 area. You get a few large orders popping up as well. You're looking at where it rotates back to. So there's two ways to do it. You're watching for the sort of rotations like that. You're trying to sell the top of the rotation, or you try and sell the break of the rotation. So you sell it there or there, and just stay aware of where that range is. So you see back there, we've done 5s again, and then it bounces back sort of 5 to 7, 5 to 7. So I'm always just trying to watch where's the low before it starts to tick back up, and how far does it tick back, to give myself a chance to be able to try and passively enter. It's almost one that you want to try and passively enter this rather than rushing to get in. The idea being to try and keep your average price nice and high as well. If you wait for it to pull back and sell, you keep your average price higher. If you chase, you're always going to pull it down. That was quite helpful, the sort of volume done around 00 there, and then it breaks through. So at this point, you're now down here. You've still got 3 minutes to go. It's clearly set a direction, so I wouldn't have any worries about direction. The only point that I'd kind of check the direction on this would be at 2 minutes to go. 2 minutes to go, I'd want to just make sure that it does keep on going. So there you go, it's got another little bit of pace in it. So you get your offers in where it sort of had that acceleration down from again. And it's still above the low. So you're still around about this point here. So I'd still be thinking about 86.25 is the point where I would sort of see it as the point of no return. If it breaks that, this is good. Then your job is just to hold it until the close. You've got 2.5 minutes to go. And the aim there being just any rotation back up, try and sell into it. Like I say, I'd be watching the clock here. Ideally, I'd want to see it break 86 before the turn into the last 2 minutes. The last 2 minutes is really where all the last orders come in. So you've 10 seconds to go now. You really want to see it go through the level.
It's not a huge amount of volume coming up on the lads in terms of the last traded quantities at the moment.
No, it's the pace that goes through. That's the thing that you don't notice it so much because it flashes around so frequently. The volumes are going up.
Yeah.
You're trading, well, this phase here, you're trading 5,000 to 10,000 contracts a minute, which is higher than average.
Yeah.
But it's the speed of it, that sort of constant flashing of the last traded quantity, kind of what you want to see as well. The further and further it goes, the more you'll see it's quite persistent. It will just hit the bid, and any tick up, it's just very quickly held back down. It kind of pressures itself onto the low. So at this point, you've just passed 58. It's down virtually on the low. This would be the bit that you think, go on, just break the low, break the low, break the low. If it breaks the low, then my mentality here would be just sit there, almost watch the clock until the last few seconds. You see someone keeps trying to buy as it went through the low there. You saw three times someone come in with 200 and again. So people are still trying to buy this, but that's always a good sign on close. If you see an order come in and it just gets hit and there's no bounce off it at all, that's a pretty solid sign for selling. In terms of exit strategy now, you're getting in towards the final minute. This is where people have varying approaches to their exit. Personally, I'd always try and hold it until I've got 30 seconds left. Some people will just try and get out in the final minute and just go out. Generally, the approach is, if you've got levels, pick levels and get out. If not, just place bids at sequence sort of intervals down the ladder to try and sort of inch you out of the trade. He's done it there and scaled it down quite quickly once it starts to flick back up. You've got 30 seconds to go. So yeah, the fact that you're best part of, in this situation, 50 handles on side, reasonably fair to try and get out of something. He has a similar strategy to the way I do it, of always keep something to the close, like right to the very, very close. You will often get on the close a sudden flush down. So it does a flick up. That's not ideal, that flick up, but you're playing for it to do the flush down, which it then does after that. And does this sort of very final, that final rush is about 25 handles down, which is pretty crazy. But that's the whole idea of it. The main bit is to try and get yourself in steady through this phase and then try and hold it for the last bit. Once you've got that clear direction, if it doesn't turn with 2 minutes to go and start coming back on you, be relatively confident it's going to do it. So then it is a case of just clock watching then. Obviously you watch out for anything that's crazy against you, but you should be able to just sit there and sit through the rotations and let it go. It's a good trade if you get the opportunity to get it. It was a pretty good day, I think. But yeah, go and have a go at them. Most of them were good, and the reason I say go and do them all, some of them were dreadful. But the point there is you don't know which ones are good and which ones are dreadful until you have a go. So you want to sort of see what a good one looks like, something like that where it was relatively steady selling early on and then it accelerates what you want. You'll get others where, the way I've always done it is you start from quarter two. Do you get any movement at quarter two? If you don't get anything really clear on the ladder, leave it, wait till 10-2. Do you get anything clear? If not, leave it, wait till 5-2. And then go for it from 5-2. If you still don't get anything, I'd wait till the last 2 minutes. Usually the last 2 minutes will give you something. The worst ones are where the last 2 minutes it starts off and it ticks it down and then it does that and it starts doing that. If within 30 seconds of it passing 58 it's doing this, I generally kind of leave that alone and go, this isn't for me now. You're just into too much of a no man's land of it, just chop, chop, chop all over the place. Right, that was the video I put on this thingy. The next thing to watch out for, and this is part of the sequence of how most crises work, in March 2020 was basically 2007-8 compressed into a month. It was wonderful, certainly for a case study at least. This is the first surprise interest rate cut. The Fed is usually the first to do it. They're the most aggressive typically, and they'll get on with it. The ECB's not. The ECB's dreadful for this kind of thing. They kind of go, oh, someone else will solve this problem. We'll hope it solves itself. Right, like the Bank of England one, you will get a bit of indication. You'll start getting talk of this. I remember it starting to be talked about on like Bloomberg News, CNBC. You started getting various pundits saying, yeah, we could see a rate cut before the Fed meeting. The Fed meeting incidentally was the 13th of March. this early March talk of not a surprise, but talk of a rate cut ahead of the meeting. The best thing to watch is your FRI OIS spread. When that starts ticking up significantly, that's the thing that's going to indicate a surprise rate cut. Stock markets dropping can also do it. We saw this in 2008. The Jan 22nd 08 one came on the back of the European equities getting absolutely hammered. They went down like 7%, and then the Fed cut interest rates. They were obviously already worried about stuff already, and then you got the equity market in Europe just drop, the S&P hit limit down, and they cut interest rates. This is one where you don't get the standard form of move. Typically, I remember being told this when I first started, if you ever see a rate cut, buy bonds. That was what we were told. If you ever see a surprise rate cut, don't buy bonds, buy stocks. Because if it's a surprise rate cut, it's a stimulus, it's there to solve a problem. So people buy stocks for the problem solved, and they sell bonds. So generally, as a good rule, just stay away from bonds. Timing also helps. For every surprise rate cut that we've seen, and I can actually add 3 o'clock onto this list now, make sure you check the time. The two in 2008, one came at 1:20, the T-note open, and one came at midday. It's likely to happen on the turn of an hour, whenever it is. I'd also just check the opens of markets as well, but assume it will happen on the turn of the hour. For this reason, you do not want to leave your desk. We had a whole sort of running to the shops between sort of 11:15 and 12:40 and 11:45 to get lunch during 2008. Part of the or what became a trade as well was just before the turn of the hour, in particular midday, you could buy equities, because what would happen is people would buy on the hope of being in case something happens. So you would get this kind of a minute before tick up in equities, and if nothing happened, they'd roll back. So you could actually play a little bit of a game of you just buy it ahead of 12 o'clock. It will tick you on side. If something does happen, you're already long. And if nothing happens, well, you've got however many ticks on side you are, space to get out before everyone decides nothing's happened. But it didn't reverse instantly, because there's always that nervousness of, well, I don't want to get out yet in case maybe it's slightly delayed. And then you get like 10 seconds after and people go, bank it, and it would whip back down. But that became a trade. You could do it every single day. You could just buy, doing the DAX, you buy the DAX and go tick, 10 ticks up, nothing happens, get out. So you could end up with 5-6 ticks every day just playing that game. On the turn of the hour, the T-note open, you usually get on 1 o'clock as well. So worth knowing those things. Generally, the way to try and think about it is almost, rather than go with the standard format or anything like that, basically go against whatever the current direction is. So if equities have been selling off, assume it's a buy. If bonds have been bidding up, assume it's a sell. Oil, the same. You could go against the oil move that was a sell-off, and you could play that back up as well. It's also going to be very, very short time frame, or very short term.
Do you mean to say like a few minutes before the event, like a few minutes before the rate cut, if you see prices pushing down on bonds, then you should buy? Is that what
it's probably worth a shot. If you're like a minute before the turn of the hour and there's talk of a surprise rate cut or possibility of a stimulus, it's a fair risk.
Go with the opposite of what's happening with the market.
Yeah. So I'd mainly do it in equities.
Okay.
The reason being, with bonds, if it is a rate cut, they may tick up and then down rather than just go straight down. So whilst you might be right, you start selling bonds, they creep down, rate cut, and it will do that, and you'll end up getting stopped out. Whereas if it's equities, if they creep up, rate cut, and it does that. So you don't run the risk of being right, but also being too far offside to justify staying in. So the thing to watch is the FRA-IS spread. This is what you started to see coming into the beginning of March. Incidentally, that's where you got to or started moving to beginning of March. That's where you got to in financial crisis. So there's still a long, long, long way to go. It never got there. I think it got up to about 100 in COVID periods versus 180 in 2008. But 2008 was a bank problem, not just a global demand problem. This is what the actual daily candle chart looked like. That was the spike. And as soon as you see it do that, that's when you're thinking, right, tomorrow's the day for it. Because that sudden spike is everyone now starting to say, basically, we won't lend money overnight. It's very short term. Yeah, if you're not willing to lend money overnight without a 5th or about 0.5% interest rate on it, that's 0.5% over the Fed rate, that's pretty significant. You've got to really doubt people's willingness to pay to ask for that much. So once you see that, you're thinking rate cut the next day, and that's the general go-to. It's the first thing any central bank will do. It will always be a rate cut first. Previous ones, the other thing on these, so T-note on the one in Jan 2008, S&P and the Euro. S&P went from 80 to 30. So S&P went nearly 50 handles when it was trading at 1,100. So just shy of 5%. A feature that I've noticed over the years, markets more move on ticks than percentage. You won't get a 5% move on a surprise Fed rate cut nowadays. You didn't get it in 2020 either. The S&P goes about as far as the S&P goes in a day, which you might go about 80. That would be quite reasonable. If it happened now, if it happened now, maybe 120 handles, maybe 150, but it's not going to do 5%, which would be what, 300 handles. I'd be very surprised if it did that. But the one feature with every single surprise stimulus I've ever seen is the equities go straight back. Timing wise is a little bit tricky, but they will at least before the end of the day. And I would say on the whole, probably within about 3 hours, go all the way back down. It's a trade that I think a lot of people miss. They hit this and then go, great, job done. And don't bother trying to play the reverse, or worse, get caught out trying to play the continuation up. Because everyone kind of goes, well, it's stimulus, they've solved the problem. And it doesn't happen. Every single one I've ever seen reverses like that. So it's one to watch for if you ever get a situation. That sort of technical play back can be just as good. Well, it's not going to be as good as the first one, because the first one is very much like that Bank of England one. This is an absolute full size, just get in. Make sure you get in on it and you'll get a massive move out of it. That's what you got January. That's what you then got in October, so it takes a lot longer to come back, but it's still back in an hour and a half. So yeah, there is still a well playable move. This was when the S&P is trading down at 800, and it still does. This one did 70 handles from 800, so 8% in about, what's that, 5 minutes? So pretty hefty moves. They all come back. In terms of these types of trades, it's a straight smash and grab trade. Don't sit there trying to play this for a bigger and bigger and bigger move. Generally, the biggest move will be the first bit, and that's the bit where everyone sort of just charges in to get their trade done. Take that, go with that bit, get in, get out. I think you probably got 3 minutes on it, around about max. I wouldn't be looking to go too much further than that. But also use some levels. If you've got a level that's a reasonable target, the good thing with stimulus is chances are you've been selling off like this. So when it comes, you've got loads of levels to target on the way up. Makes your life a little bit easier than the other way around. So pick your levels, get your hourly charts out and go and pick where you think you can get to. Each level that it goes through, that's that one ticked off. Does it stall at the next one? No, ticked off, next one, and just move up like that. Like I say, I think you've probably got around about 3 minutes to go, or 3 minutes on this type of thing. Generally the quickest one's the S&P. The other thing to think about is alternative markets. So example being something like Euro stocks. If it's a Fed rate cut, Euro stocks isn't the worst choice because less people are going to go for that. Something you've always got to think about is competition for entry. If every person in the world is going to go and try and buy the S&P on this, it's a really hard trade to get on. At least it is to get on any decent amount of size without paying up miles. You can be better off to go and hit the Euro stocks where you can hit more size for a smaller but probably more stable move and be more comfortable on the trade than trying to join everybody in the scramble into the S&P. So that's the thing to consider in that respect, which one you're going to go to. Different alternative would be, and actually the people who did best on this were the people who sold the bund. Because the rate cut comes, the bonds ticked up and it gave you ages to sell. As long as you've seen these before and you've seen the reaction that the bonds don't stay up and they go down, the bund basically ticks up 20 ticks, it gave you all the time in the world to sell it. That for me, if we ever got something like this again, would probably be my go-to.
Is price, if the bund is sticking up, is price moving up to take out liquidity before coming back down?
I don't think so. It's going up on the theory that, well, if rates go down, bonds become more attractive. You should buy bonds that are yielding 4%, because if rates have just dropped to 3%, these bonds are more attractive, you should buy them. But being stimulus, people buy them, and then there's this realization of, well, I'm better off to actually sell them and buy stocks instead, because this could be solving the problem. As it happens, it never is. And it's, in my view, like an admission of a serious problem. If you're willing to suddenly come in and cut interest rates, it's a pretty big problem rather than you're just going to solve the problem with a rate cut. So to that point, this is what you then got. This was Tino on the move. So that was the move by the end, or on the hourly by the end of the day. This was the move on the decision or on the release. So you get this flip up and then down, and that's the one to play. It will reverse that as well, because overall the theory is bonds should go up. So it makes sense to go up, but the initial is this kind of switch to equities and then switch back. So you just got to be aware of that, the sort of sequence of it. I would suggest the best approach is to go equities first, because they will just go straight up on it. And then that means that you don't get caught selling the spike up. The bonds will have jumped. Once they've jumped and they stall, then you can sell the bonds. So you end up with both sides of the trade. That's then the S&P on it, which did 80 handles. So it only did slightly more than it did when it was trading at a quarter of the price, but 80 handles. And I'd say 3 minutes, you pretty much got to the peak. So that's about as far as you want to be going on these. And then you got Euro stocks as well, which did equally about 65 ticks. Euro stocks a lot thicker though. It's a lot easier to get your positions on. Nice gap for a target as well. So that's, they're your options. And then the only other one was Bund, which that move's not gigantic, but it's still 60 ticks. So as long as you sort of, the advantage is there, you can get in as much size as you want, because you can just average into it. Particularly if you're already long stocks. If you're long stocks and you're 50 ticks on side, averaging the Bund up 15 ticks isn't so bad, particularly when you've got that sort of clear idea that it's going to roll over. I'll show you how it trades. Right. Where's this one gone? There we go. Okay, so what you've got on here, that's S&P, that's stocks, that's a scribble, that's stocks, and that's Bund at the end. You keep your eyes on Bund when it hits. I'm just trying to see if I can see the time. You go on Bund, the Bund ticks up with it, and then you start to get the reversal on it. So unfortunately for him, he was actually short Euro stocks as it comes out. That's the news. So you can see the S&P is absolutely flying on it. I'll ping it back quick. Once you get that, when it first comes out, there you go. First seconds, the S&P does 5 or 6 handles, I think, probably trading from about the mid 50s. Euro stocks does 10 ticks. The Bund doesn't move. So you've got a lot of time in the Bund. Also liquidity, you've got 10 times the size you can do in the S&P, in the Euro stocks, which is the reason to go there. It is one, Joe was asking about this the other day about having a stop. If it's significant, you just can't reverse it. You know this is a big deal. Yes, you're taking a 10, 15 tick loss. Don't worry about that. Just cut and reverse. Whatever you lose, you'll make back pretty fast. The S&P has gone, that's done 50, 60 ticks already. The stocks is then at this point up, getting through, or getting towards that gap as well. And you've still got the Bunds trading 15 ticks higher. So you start to see it starts to sort of stall out around here. That then you see it keeps on sort of getting stuck around 64, 65 area. This then becomes the point where you can start thinking, well, if all the equities are up, you could get the sell-off in the Bund coming. So that was your chance then to have a go at selling the Bund. You will get stuff like this, large orders will chase up, you've got 1,000 lot chasing it there. That's a chance to, very, very quick front runs in these types of things. Don't hold on to it though, expecting loads out of it. Get ahead of it. You saw it there, it jumped up and it got hit, because if you don't get out quick, they'll just get hit.
And if you're scalping it, you're running open stop loss, right?
Yeah. I wouldn't want to try and scalp this. Yeah, if you're going to just front run the large orders, fine. But I wouldn't want to try and scalp anything here. The goal would be here, you're going to try and hit this, hit it big, hit it once, and get out, rather than trying to go in and out and in and out and in and out, because you'll get too many of them where you'll get in and you'll end up with it flicking against you in a not great position. And so you end up sort of taking your losses. Having seen a few of these, I would say your best option is you just hit it hard, hit it once, play it for 3 minutes and get out, particularly in the equities, and then you've got the chance to then go and get on the bonds. Okay. A good approach to these. This trade is not particularly, good's the wrong word, but he's not someone who does this a lot. A good way that some people do it, they'll hit the stocks or hit the S&P, let that go and watch the bund and try and get themselves into the bund. The idea being there, if you focus on trying to get in the bund, you carry all your size in the equities rather than get in, get out, 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 in, out, and then try and sell the bund. If you just hit one and watch the other, then in you're trying to manage your entry on the bund, you let these go as far as you possibly can. There's got to be an element of reason within that and go, well, do I really want to be sort of chasing this too far? But that's the way that you're going to try and do it. It all starts to stabilize relatively quickly, as you can see, particularly from the equity perspective. You're up in this area, it all starts to stall, it sits in a range, the game's over. Once it starts to sit in a range, this is where people get, trapped's the wrong word, but people get sucked into doing the wrong thing and trying to play for the next leg up, and they try and play this as like a little flag and a continuation, and that's where people get caught out. Once you start to get that, this is then the point where what you want to try and do is just get out towards the top of that little range or somewhere in the range. You know, you're still going to be a huge distance on side. So that's how I'd approach those ones. You'll get one, who knows when, but you will get one at some point. I'd say that they're more likely to pop up than some of the other things. You know, you've only got to get a bit of a period of panic, of worrying situations, and suddenly that will start happening. Right. Instead of Euro stocks and DAX are getting really hit today. That play starting to work out now where people just don't want the European equities, but it's not dragging down the S&P, which I was saying about the whole idea of the difference between the two is now widening, and it's just widening because the Euro stocks is dropping more so than anything else.
Is the point ready?
Bund's just sitting in the range. Bund's just up down today, but which I don't think's a surprise. It's more the equity play than anything else at the moment. Yeah, that's a more obvious one.
Is it Trump's first day of office or something?
No, they don't get inaugurated until mid-Jan, sometime around then. I don't know the precise dates, but it's sort of mid-Jan. But you have this period now where Trump can start to talk about policies that he's going to implement, so you know roughly come the moment of action, that's what's going to happen. So you know.
Market react or anything now or too early?
Market will react now if there seems to be clarity on what he's going to do. Yeah, I know there's all the manifesto and the stuff he's talked about, but until he's clear that, and there's a belief that he will get the things through. There's one thing to say it, there's another thing to get enough backing. Even though the House and the Senate are both Republican, there's still a line as to how far you can go before some of them are going to go no. Some of them are genuinely politicians and reasonable characters. Then they're not going to vote for some of the really wild stuff. Right, perhaps do a quick explainer of this one. You can go and have a go at trading them actually. I'll give you a list of when they were. Limit downs. Now, limit down has changed in US equities post-COVID. It used to be a situation where you had a 5% limit pre-cash. Then once cash opens, you had a 7%, 13% and 20% limit. Once you hit 20, the market shuts. No one's ever seen that. 1987, it went 22% on the Dow, and that I think was when they brought in the limits. So no one's ever seen 20. I'm not sure I've ever seen 13. I'm not sure anyone else would have. Maybe 9/11, maybe some period during the dot-com crash, but it certainly wasn't in 2008.
Flash crash?
Nope, flash crash didn't even make 10. Or 7, as it would have been actually. No, it didn't. It nearly got to the limit. There's a great video on it. I'll send it to you. Right, I'll explain the idea of it. Again, if you Google CME price limits, it tells you where the limit up and limit down is on any given day. Once you get past the New York Stock Exchange open, so prior to the open, it's a 7% limit down. You cannot go beyond that. It's also a 7% limit up. Post the New York Stock Exchange open, the 7% goes, assuming that you've already hit it, and there is no upside limit, which seems bizarre to me. I think if you're going to have limits, you should have them both ways. Incidentally, apparently there is an upside limit on oil. It's basically don't like commodities getting too expensive, but stocks, you can go wild. Seems a bit nonsensical to me, but there you go. So if it's pre-open, what you will end up with is if the S&P trades 7% down before cash open, it will hit the limit and it can bounce off the limit.
China sell-off. Do you remember there was a big sell-off in China? Did we hit 7% on one of those?
There you go.
Okay.
Yeah, it did. Yeah, That was the 2015 Chinese devaluation, big sell-off phase. Yeah, absolutely. With the pre-cash limits, what will happen is it can hit the limit and it can trade off the limit. What you'll usually get is something like this. Excuse me, where you'll get an enormous offer on the limit. Basically, it's anybody who hasn't sold or wants to sell or is long puts their offer there. It can still trade, so people can buy at market. Why you buy at market there, I have no idea, but you can't buy anywhere else. But I still don't understand why you buy. It's not a safe place to want to be long, and if you're short, surely you wait for the open and see where it reopens.
Because as soon as the circuit breaker time period goes off, it could gap down again, right? So it's said it could only drop another 3%.
Precisely. That's the idea, that yeah, what will happen is 5 minutes before the open, the limit will lock. So if it's on the limit, no more trade, and then it auctions like the 11 o'clock open and opens wherever it opens. One thing you can do is when it hits the limit, sell the European equities, because if you've got to hedge a long, rather than trying or praying that you get filled on that massive offer at the low, if you're not the first person in that queue, it's a horrible situation just sitting watching it go tick, 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 tick through until you get filled. If you don't do that, you could sell the Euro stocks or sell the DAX as a hedge because they don't have a limit. So they could just go and go and go. It's one, if you want to be short, you join the offer and watch it tick through. You've sat there with that, sitting there for like an hour, watching it go 1, 2, 3, and it ticks through, ticks through, ticks through until you get filled. As long as you're in before it locks, you're all good. Like I say, you can find the limits out there. Keep your eyes on the Europeans as well. The European ones are probably the best place to hedge, and they'll be the ones that will then react on the limit. This was a 2015 one. I haven't got any of the examples going back to 2008, but there was 2 or 3 during that period as well. Once it hits the limit, so once it goes down and hits the limit, that's your chance to then sell the European equities as soon as it hits the limit. You'll get this quick rush into the Europeans, and then also when it reopens, you will then often get another sell-off on the European equities at the same time. So that's something to watch out for as a different approach to trading it. The one in 2015 was the weirdest limit down I've ever seen because it opened about a half tick below the limit. You would think it's going to limit and then open lower, and it opened half a tick below and then traded straight to the next limit, the 7%, and bounced off it. Really bizarre. I can't explain why it would do that. You would assume it should have just opened and gone straight for it. But that's the basic idea of the trade. If you can get short, you assume it's going to reopen and flash down like a stops type move. Because all of those 3,000, 6,000, whatever, that hadn't got filled, if they still need to, they're going to execute on the open. So that's the way that will impact the open. The other reason to watch the Europeans, particularly if the S&P goes limit down, is to work out if it might bounce off the limit. If it's pre-cash, it can bounce off the limit. So what I'd watch out for, this was the, and this is a good warning sign, the Fed cut interest rates over the weekend, and the S&P didn't even gap up. It opened virtually where it closed. If it can't even go up on a rate cut over a weekend, so that was a rate kind of restart of QE, it went straight down. That's a 15-second chart, and it went straight to the limit within about 5 minutes. Straight limit down, and it sat there. What then happens is once the European equities open, you want to see where they're trading when the S&P hits the limit and make a mark of that, because that's the equivalent price. If the Europeans go above that, the S&P will ping off the limit. So if you're short the limit, hoping for the gap down on the open, if the Europeans start trading back up, it will ping you off the limit. So just something to be aware of. Whilst it doesn't look much, that jumps about 15 handles. So it's brutal enough to get you out of the trade. If you're short on the limit, you've got a massive offer. So you can see the Europeans starting to tick up. If they tick through, you can hit that offer. As long as you're quick, you should be able to hit it. Just bear in mind though, that offer's going to dwindle very, very quickly. People won't stay offered that if it looks like the European ones are going to go up. But well worth watching. The other thing is, this is the European overnight session. As soon as the cash session in Europe comes in, if the S&P is already on the limit, same principle, people will sell the open, which is a pretty hefty move. That was the DAX. DAX did 400 ticks on the open. That's a 5-minute chart, but it already gapped down 800 ticks. It's a pretty hefty move. Right. this is one I was going to go and have a look at. I might let you guys go and have a go at trading this one. This was the 12th of March. A lot happened on the 12th of March. You had ECB rate cut, limit down S&P, Fed repo trade, and the epic close. Probably the 12th of March, probably the best day of the whole thing, or the most active day at least. I'll let you guys go and have a go at trading it actually. That's the limit. So if you start it from about, you might bear in mind the time change. So it'll reopen at 1:30, not 2:30. Go and have a go at it. See if you can get filled on the limit. If you can't, what happens on this one, it reopened, it went open, limit down instantly, and then locked again. So that's the one to try and get in quickly on the reopen there. When it reopens cash session, it goes bang, locks on the limit. So it sits there for 5 minutes and then it locks out. After that, it then gaps down once more. All of the limit downs, limit ups that I've seen as well generally reverse on the day. Don't have to do it super fast, but they will generally manage to reverse back to the original limit. All of them that I've seen have done that. So that's another trade for you to have a go at. Which I'll show you a bit of the limit down trade and the reversal trade on Thursday when we do it. We'll go and have a go at that. One of the guys' record best day was on that. He got short the S&P on the first limit, and then it went straight limit again. So he managed to capture the whole 2%, and then it opened and then went down another 30 handles on top of that as well. So it was a good day. That's still the record best day ever here. I made 3.5 million. It's a good day, yeah.
Nice.
Yeah, so we'll do that one tomorrow. We're going to have a look at the limit and the breakdown on that. Not tomorrow, sorry, Thursday. I'll wrap it up there. I'm getting a bit tired and my voice is starting to go. It's a good point to end. Tomorrow, 10 o'clock, we'll do CPI prep. Get everyone prepped, ready for that. Go and trade it. Hopefully everyone can do really well and hopefully CPI comes out of line ultimately. Right, I'll leave you there. Go and get a good night's sleep and I'll see you all tomorrow.
Yeah, thank you.
Thank you.
It was a busy day, yeah.
Not talking to David.
Yeah. I need to pre-record these ones, but there was an element that something might change. You want some new stuff to talk about. I've always kind of left these. You also usually get a lot of questions.